Caterpillar stock, where's it going, where's it headed from here? If you're new to the channel, I do weekly analysis on companies just like this, showing you what's cheap, what's fair value, and what's even expensive in the industry. So if you haven't already, click that subscribe button. So for Caterpillar stock, we have price per share of $365.63. We've got a price to earnings ratio of 18.15, a market cap of 182 billion, and an enterprise value of 213 billion. So right away, could be a little bit of undervalued potential here, just based on them having a higher enterprise value than their market cap. If you don't know what Caterpillar is, go ahead and pause the video right now so you can read this description. Looking at their financials, there's a cash debt ratio of 0.18, meaning for every dollar of debt they have 18 cents to pay down those debts. Not optimal. I do like to see at least one, so they could pay down the entirety of their debts if they had to. But looking at their profitability, we see a lot of solid green. So some great margins here for the business. Teens or higher versus their historical performance. These are the highest gross margins they've achieved in the last 10 years. Same story for their operating margins, highest 10 years. Net margins, again, the highest. And free cash flow as well. So it looks like their margins are doing, well, the best they've been in the last 10 years. So excellent sign there for their margins. That is what I want to see from a business. I use those to tell me about the financials and the profitability currently of the operations. But for management, I use ROE, ROA, ROIC, and ROC. And for these, again, they're doing excellent in the industry, and versus their historical performance, just about the highest for each of their numbers. The management is in a good position. Same thing with their profitability. The cash to debt, I'd like to see at least one, but 18 cents is better than zero. When it comes to the price to earnings ratio, they have 18.15 for their current, a median of 17, and a minimum of 8.92. So just about that median, a little bit above their median actually. So we see revenues fairly, not up and to the right, which is what I would like to see. I would like to see these revenues. This is 10 years ago. They had revenues of, well, this is 2012. They had revenues of 65 billion, and now they have 67 billion in revenues. So the revenues are not accelerating even over the past 10 plus years. But looking at the trailing 12 months, we can see that those revenues are up and to the right. But again, on the shorter time frame where we look at 2021 till now, we can see that revenues as well as net income are up and to the right. I'm not a fan of the revenues being just about what they were 10 years ago, but this is a fairly solid business, and we see net income in all these years. Even the worst they did, 2016, with negative 67 million. So pretty solid margins, good net income in relation to the revenues, and fairly steady, at least recently. Cash to debt in pace with each other. Looks like debt is pretty flat over the last few years, and the cash pile even coming down a bit. So again, I would like to see a little bit more cash to debt, but this could be a debt intensive business. Here's a sign that I like to see, some share buybacks, so increasing shareholder value by decreasing the share float. Because when a company buys back shares like this, it takes them out of the marketplace, which means every share you have goes up in value. We can see their operating revenue by business segment has 41.8% in energy and transportation, 40.9% in construction industries, 20% in resource industries, 5.6% in financial products. They lose 9.2% in corporate items and eliminations, and another little tiny sliver there. By geographic region, they have 46.3% of their sales in the United States, 20.4% in Europe, Africa, and the Middle East, 18% in the Asian Pacific, 9.9% in Latin America, and 5.3% in North America. But to see what it's currently worth and where it could be headed in the future, let's run a DCF. Before we do that, if you do enjoy these type of videos, leave a like. Make sure to subscribe to the channel so you can see the better videos that are coming in the future, and maybe even something different But the goal is 500 subscribers so that we can monetize certain things on this channel and bring you guys even better content in the future. So help us get there. But back to business. Based on earnings per share and seeing what's currently priced in, there's about 11% for the next 10 years priced in to equal roughly what we are at today. So this is pricing in that the business will grow its earnings per share at 11.3% annually for 10 years to equal roughly what it is today. So if you believe it's going to be faster than that, maybe closer to 14, or even that past 10-year average of 13.3, then a fair value should be closer to 423. If you believe they can accelerate to 15 for the next 10 years, leaving us with a fair value of 483. And if you believe that they should slow down to 9%, then we could see a downside of 324, whereas we're currently at 365. Looking at free cash flow, we can see that based on their last 10 years, they had an annual growth rate of 7.1, which would give us a fair value today if they were to achieve that for the next 10 years of 252. So if you see some acceleration and you think they're going to grow closer to above 13.1, so 13.1 is priced in to equal roughly what we're at today. So somewhat closer to that 5-year average. Maybe if they grow at 15% for the next 10 years, we could see a fair value of 430. And on a bearish estimate, if they don't get that 7, which they had for the last 10 years, and they get maybe 5 or 6, then we could see a fair value closer to 236. So it all depends on what they're earning, and then again, stocks can trade for a premium or a discount. So this is just fair values, and it can always trade like it is currently for higher than their fair value or lower. So based on free cash flow, it looks like it's trading for a slight premium, although this just means that they're pricing in more growth than they've achieved in the last 10 years. It's priced in to grow faster than it has in the last 10 years. Whether you think that's accurate or not is up to you. So that's what I mean when I say it's priced at a premium. And based on earnings per share, it looks like it was actually priced a little bit cheaper than their last 10 years. But that being said, this is my analysis of Caterpillar, ticker symbol CAT. If you like these type of videos, make sure to subscribe. I'll be posting just about weekly. If you enjoyed the video, leave a like. If you have any questions or comments, leave them down below, and I'll see you next time.